Welcome back to the Daily Nugget, daily property insights, one topic, 20 minutes or less, 7 days a week. Myself, Lawrence Lotze, and today joined by Matt Harris, a property tax specialist and fellow property investor. And Matt, a question to you today. We did a bit of a part of this just the other day talking about inflation, but today I want to cover off what is hyperinflation? It's a term that gets used, but I mean, what does it mean? How is it triggered, and what is the impact of it?
Yeah, so hyperinflation is an economic term,
Mm-hmm.
and what it means is inflation that is occurring at a rate faster than normal. And what's normal will be determined by each country's economic policy and its mandates for the control of inflation. So in New Zealand, for example, the mandate is to keep inflation under 2% annualized. And it's important to remember that it is annualized because at the moment, inflation's been 4.5%, but that's for the quarter. That's not the whole year. And so we have to wait till the whole year plays out to know whether we've actually got hyperinflation or not. Hyperinflation typically occurs when governments print currency. So QE, or quantitative easing, is commonly referred to as the printing of money, but it's actually a lot more than that. And they don't just put a printer in the window at the Reserve Bank and turn it on and let it spit out into the streets. What the government does as part of the QE process is they do print money. So they're trying to put more money into circulation, but they also assume debt from big businesses and other government agencies. So move it off balance sheets. And there's a number of other tricky, more technical things that they do that aren't just printing money. But QE is a really good way of referring to it. Printing money is an even easier way of referring to it. And what happens is all this extra money in circulation increases spending. And in New Zealand, for example, this inflation or hyperinflation has occurred in the property market, which is up a huge amount on an annualized basis. What that does is encourages people by default. Obviously, the government's not encouraging people, but they encourage people by default to borrow more money because the equity has gone up in their property. The interest rate is really low, 2%, 2.5%. So people go out and they borrow money, and they borrow it to buy more houses, and they borrow it to buy luxury goods, boats, cars, spa pools, which I've used as an example before because it's really hard to buy a spa pool at the moment. And so, so what happens is that hyperinflation theoretically is actually a devaluation of currency because you need more money to buy the same things that you've always wanted. So I use a really good analogy. I'd really like a new beach house at Waiheke, except the beach house that I used to want has now tripled in price. So I need quite a lot more money to buy that house. And the same applies to people's everyday lives. If you're earning $80,000 a year, the $80,000 that you earned last year is not the equivalent in buying power of this year. So hyperinflation erodes your buying power at a faster rate than normal.
Yeah. And it's very similar to when we spoke about inflation itself. It's a divider. It breaks. It has a quicker at the top and slower at the bottom. And then fundamentally what Matt said, my dollar is worse every day by day, and hyperinflation is greater inflation than expected and on a continued path. So it's not that it's my dollar gets worse and then it's going to be better the next day. It's just fundamentally losing money. So it's sort of that old analogy that money in the bank or actual available money in the bank is worse every single day. So your $100,000 today, tomorrow, in theory, is actually worth $99,000 and then $98,000. And depending on the level of hyperinflation, if you look at the big countries out there, hyperinflation, the famous ones like Zimbabwe and stuff, that I think they've got billion-dollar notes, which are worth $1 or $2 because the hyperinflation just went out of control and just bigger and bigger. So everything just got devalued. And your money was just pretty much worthless at the end of it.
Yeah, totally. And I've said this before, I'm not an economist, can't be held to my thoughts, but the irony of it is that when you have a devaluing currency, those who try and protect themselves from it deploy that capital into assets because, as discussed before, assets are inflating at the same rate as everything else, or even higher. And so you deploy that capital into those assets, and by default, you make hyperinflation worse. So it's a difficult one, and this is, I know we've discussed in other episodes the OCR and things like that. Those are the tools that will be needed to control inflation moving forward, because they take more money out of people's pockets, and they slow the rate at which you deploy it into properties, especially because that's the main thing that's affected by the OCR.
Yep, totally agree with that. And thanks so much again, Matt, for today. And to anyone else that's got any questions or queries that's listening or watching, just let us know. Details will be in the description, depending on what platform you're listening to. And thanks for coming over to the Daily Nugget. Daily property insights, one topic, 20 minutes or less, 7 days a week. And as always,